In Canada, the tax-free savings account, commonly known as the TFSA, is widely considered the ultimate wealth-building tool. This chart illustrates exactly how it works. You put your after-tax money in, invest it, and watch the balance grow. When you finally pull those profits out, the Canadian government takes exactly 0% of your capital gains and dividends. So an American living in Toronto or Calgary walks into a local bank, hears the pitch, and opens an account expecting to enjoy those exact same benefits. But the United States does something almost no other country does. It taxes its citizens based on the passport they hold, regardless of where they actually live or work. The US and Canada do have a robust tax treaty that protects traditional retirement accounts, like the RRSP. But the TFSA was created in 2009, long after that treaty was written, and the agreement is completely silent on these newer accounts. Because the IRS does not recognize that tax-free label, this everyday savings account becomes a massive, unprotected liability for American expats. Normally, expats avoid paying taxes to two countries at once by using the foreign tax credit. It usually works like this. If you pay $100 in income tax to the Canada Revenue Agency, you get a $100 credit to offset what you owe the IRS. The scale balances out. But inside a TFSA, Canada charges $0 on your investment growth. That means you generate exactly $0 in foreign tax credits. Without that credit to absorb the blow, the IRS treats the interest, dividends, and capital gains inside your Canadian account as fully taxable U.S. income. You have to pay out of pocket to cover it. The absolute best feature of the TFSA in Canada, the fact that it is entirely tax-free, is the exact mechanism that breaks your U.S. tax shield and guarantees a sudden tax bill. Paying the tax is only the first problem. The IRS also requires extreme visibility into any money Americans hold outside the country. Just holding the account triggers standard reporting requirements. You have to disclose the balance to the U.S. government on an FBAR, and depending on your total assets, a FATCA Form 8938. But because of how TFSAs are legally structured, the IRS can classify the account as a foreign trust. That classification triggers two of the most complex documents in the U.S. tax code, Forms 3520 and 3520A. Missing a deadline or improperly filing just one of these trust forms triggers an automatic penalty, starting at $10,000 per year. Between the sheer volume of required filings and the constant threat of massive fines, a basic retail savings vehicle turns into a high-risk compliance nightmare. The trap snaps shut completely if an expat does what most regular investors do, use the account to buy standard Canadian mutual funds or exchange-traded funds. The U.S. tax code categorizes almost all non-U.S. mutual funds as PFICs, which stands for Passive Foreign Investment Companies. This graph shows the damage a PFIC classification does to your returns. Instead of a smooth growth curve with favorable capital gains rates, the IRS strips away those benefits, taxing your gains at the highest marginal rate while adding compounding interest charges. And you must report this math, filing a complex Form 8621 for every single mutual fund, every single year. Holding a normal, diversified Canadian mutual fund inside your TFSA creates a toxic blend of punitive taxation and overwhelming paperwork that will entirely wipe out any return you hope to make. While the rules are strict, Americans living in Canada can navigate this system safely if they know exactly what to avoid. First, avoid the PFIC poison pill completely. Never buy Canadian mutual funds or Canadian domiciled ETFs inside a TFSA. Second, if you do decide to use a TFSA, restrict the holdings inside it strictly to cash, individual stocks, or U.S. domiciled ETFs. This keeps the reporting straightforward and avoids aggressive tax classifications. But for serious, long-term investing, American expats should look past the TFSA entirely and use a Registered Retirement Savings Plan, or RRSP, instead. Unlike the TFSA, the RRSP is explicitly written into the U.S.-Canada tax treaty. The IRS officially respects the Canadian structure of the account, allowing your investments to actually grow tax-deferred on both sides of the border. Crossing an international border rewrites the basic rules of your personal finances. Whether a savings account is truly tax-free doesn't depend on the country you live in. It depends entirely on the passport in your pocket.